So to kick off with jobs, especially in the U.S., you can see that in March 2022, you get an idea of just how strong it is, especially when you compare it to April, when you compare it to February. You know, you're seeing pretty much hitting at all cylinders across the board. You know, we've seen a big decline in the amount of people not working 27 weeks or more. You've seen people come back from retirement, So participation rate is going up. So again, everything is showing just this massive growth, which again also leads the Fed the ability to raise rates more aggressively, with this being one of the key factors. Now, when you look at the successful job hunting, unemployed U.S. workers are increasingly more successful securing a job. Why? Because there's a big shortfall and the workers are there and people need to hire. So job finding rate from Atlanta Fed shows estimated 32.1% of workers who are unemployed in January found employment in February. Tight U.S. labor market is helping Americans find jobs in addition to switching or finding better pay and flexibility. Again, all of these things pointing to just the strength in which that they can come out and raise rates. But remember, this was our base case. Our base case was that, and it started in February. Our view is that March through June, you are going to have a lot of turnover. You can have a lot of new jobs. And you have to just think about when people quit. You know, people typically wait for their bonus, which can be paid out in December, January, February, depending on where you work. Once that's paid out, they'll quit. They might take 2 weeks off, a month off, garden leave, whatever. And then they'll start looking for a job or already have a job lined up. And again, you're not going to leave a job unless it's a significant move. Like, you know, some people will do lateral moves. I'm not saying that they won't, but most will want a pay raise, a promotion. So again, all of these things are net benefits when you start looking at wage increases. But increasing wages also increases input prices, which increases costs, which increases price to the consumer. And then you get an idea on that, again, that wage spiral. So it's also some of that backdrop on that sticky inflation, because you don't typically knock down everybody's wages. You know, once you hire them, you're not changing them up and down. So again, this is where you start to get some of the additional increases in price. Now, the climb in wholesale inventories remain strong with 2.1% gain in February, and it haven't declined since the summer of 2020. So again, inventories building back up, leading to the ability to not ship and to avoid some of that trucking, leading to, again, some of that weakness that we've seen on the diesel market. Then when you look at February factory orders, again, leading indicator, expectation was for negative 0.6, came in at negative 0.5, so right there. Worst monthly decline since April 2020. Year-over-year gains off peak, but remain healthy for now at 12.6%. So again, you're still on a healthy level on new orders. It's just you're starting to see that slowdown, and that's what we continue to talk about when we're looking at all of the different pieces. So then when you look at U.S. trade balance of goods and services in the top left, February trade deficit stays near record, virtually unchanged. So it was at $89.2 billion versus the estimate of $88.5. It's still there. Goods trade deficit eased a touch in February to $106.6 billion versus $106.3, but you're just getting an idea in terms of where things are in general on how we continue to spend. But then when you start looking at where we sit right now when we're discussing household savings rates. So as we've been talking about with the slowdown in rates, this is just showing coming negative. And I think that, again, this is looking at fourth quarter 2019, and the percentage of income where so much less is going in because of inflation, that's going to become some of that underlying piece where you're not spending it on things that you want to spend it on or invest in, but it's to cover your increasing living costs and your increase in living, food and gasoline and diesel, and all of these pieces are leading. And then rent, and we have a rent charts in here and other showing all of those pressure points. And it's not just the U.S., it's the OECD, as we described and showed in an earlier slide. And then the consumption component of real GDP in 4Q 2021 was revised down. In terms of contribution to headline growth, it clocked in at 1.76%, largely in line with pre-pandemic average and well off of peak. So the idea is that you're going to continue to see that come down, especially on the consumption front when you look at real GDP as we continue to talk about those different pieces. So in the 1970s and 90s, environment of mostly counter-cyclical inflation meant that increases in CPI, the orange line, coincided with declines in economic activity. Since 2000 until recently, the relationship has switched to mostly pro-cyclical inflation. So the question now is, do we start to see that again? And that's going to be an interesting point of where is the Conference Board composite? Where are the indicators where if you have inflation going up, does that mean that all of a sudden you have economic activity going down? So far people have weathered the storm, but as things get worse and as things expand, people do less. And that's what we continue to see and talk about. And this is just looking at why. So the spread between expectations and present situation components. Consumer confidence index continues to sink further into negative territory. Level remains consistent with prior recessionary periods. So it takes time. The U.S. consumer had a lot of money come through. We haven't really been in an inflationary spiral in a very long time. So it's when you start to compare it back to the previous slide we're going to be more like the 1970s than any other period. So that's why we expect to see some of that movement where economic decline increases, or I should say decelerates, as inflationary pressure picks back up. So then when you start looking at the Conference Board confidence, it came in at 107.2 in March versus the estimate of 107, slight uptick, but well off of recent peaks. Present situation rose to 153 from 143. Expectations, though, tanked to 76.6 from 80.8 because people are expecting more problems. And as people expect more pain, expect more issues, that's when you start to see the expectation then starting to adjust the way actual spending happens. Consumer optimism about business conditions in the next 6 months has dropped to the lowest exact same level since March 2020. And you get an idea of just, again, how things are going to continue to worsen. Consumer spending came in at 0.2% in Feb, but fell 0.4% in real terms. Disposable income came in at 0.4%. Inflation adjusted, though, came in at negative 0.2%. So again, negative movements. Savings came in at positive 0.2%, to 0.2% to 6.3%, near the 2013 lows. PCE prices, inflation came in at 0.6 or 6.4% year over year, the highest since 1982. Core prices continuing to move up. So again, when you look at the real personal side, you can see that durable goods slowing down a bit and services are creeping back up, back to what we talked about in segment 2, where you kind of get this merge together as they consolidate, where services pick back up, thinking PMI, services PMI, and as the manufacturing slows, that's going to continue to be the case. So then when you start looking at U.S. personal income excluding transfers, inflation-adjusted personal income excluding government transfers continues to go sideways. So as inflation's going up, you're having just the income doing nothing, increasing the pressure, while everything that we talk about with housing, I laugh at this every time. I shouldn't, because it's not funny, but it is. So average hourly earnings continue to obviously go up, but just look at the continued parabolic move of the house price index. So again, the ability to afford a home is becoming harder and harder unless you have something to sell. So then when you start looking at wealthier Americans are having second thoughts about second homes, demand for vacation properties has plummeted to the lowest since May of 2020, with tight supply and rising mortgage rates, slowing activity. And again, primary homes kind of being flat, but second homes rolling over. And second homes is usually a precursor to things slowing even further. So then rates argue for a meltdown in the new housing. So higher rates of late likely to put pressure on housing leading indicators. Home buyer mortgage payments are up 28.1% year over year. And again, that's going to take time, but that will lead into additional slowdowns in terms of spending and home buying. The mortgage daily 30-year fixed rate is now over 5%. We're at 5.02. It's the first time we're back over 5.02 in a long time. So again, just showing the pressure, but it just happens. So it's not like it just happens and people instantly look at that and be like, oh, have to lower the price of my home. No, it takes time. How many people have a pre-approval at a fixed rate? Again, these are things that take time to work through the system, but as you start getting into June, July, all of these price increases are going to hit, and that's going to create some of those bigger problems. And housing, if housing is slowing, it'll show up in builder cancellations. Well, and so far, builder cancellations haven't started yet. So we're still waiting to see what the data looks like, because as that increases, then that's going to be like, all right, well, now things are slowing. They're going to focus on the completions, because as we've been talking about, housing starts are way up, housing completions are way down. So I think this is going to increase as they look to try to close that gap. Now, when you start looking at where people are moving, you can see that people are moving out of the Northeast. There's parts of the Appalachia, the Midwest, and they're moving into, as you can see, some friendlier tax regimes. So again, these are things that we believe are going to continue to be the case as we get some additional transfers into other regions. But then the biggest spread on the cost of owning versus renting, it's the biggest spread since 2007 on the cost of owning a home versus renting a home nationally. More expensive to own than to rent a single family house. And again, this is usually the extremes before we get that big drop. So then when you start looking at U.S. pending home sales index, the expectation was for negative 2.2%, actual negative 5.5%. So again, those slowdowns that we keep talking about, and as people start to walk, you'll get some of your pre-approvals expiring, and then rates are going to drift higher. So active listings of homes for sale, negative 22.6%. 4-week rolling average of weekly active listings. 45% of pending sales under contract within 1 week. Still strong because we still have a supply problem, but that is, again, readily getting adjusted over the next couple of months. Redfin Home Buyer Demand Index, 5%, still up there. 51% of homes sold above list price, again, still there, still strong. It's just, it takes time. And that's what we keep talking about. Everything we're discussing doesn't happen overnight. This is something that, rates just went up. Things are starting to slow. People are starting to get concerned. Inflation's starting to hit harder. These are things that, again, are rolling over and are going to be more impactful, which is when you start looking at home buyer mortgage payments up 30.5% year over year. That is a huge problem. Zillow observed rent index year over year, it's at 17%. So then you start looking at the Freddie Mac US mortgage survey. Mortgage rates are rising with speed. 1 year change in average 20-year rate is now fastest since early 2000s. So the speed also catches people off, by surprise, because you have a pre-approval. The bank can't go back on that, but the next one is going to be mark to market, and that's when you start to see that hit. And again, it takes time to see that filter through the system. U.S. pending home sales weaker at 4.1% versus 1%. Again, all things considered, the surge combined with rising mortgage rates translate to another $200 to $300 in mortgage payments per month. Home prices accelerated again, though, in January at 19.17% year over year. So you're seeing like it's just kind of staying up here, because if you're Bob and you see that Billy sold his home for this crazy number 6 months ago. Now you put your home, because you believe yours is nicer than his, so you put yours $25,000 above what his was. Now it's still above where it was from 2019, and you're not getting any bites. Well, my house is nicer than his. Why isn't mine selling? And then you start to get this seller where I refuse to lower because it was just so strong. And that's when you start to get this kind of battle back and forth between buyers and sellers. And they're going to have to start to recognize mortgage rates are going up. Things are starting to get a little bit different. And now when you start looking at the unemployment rate, again, coming back to rates and where mortgage rates are going, the 30-year, the curve in general, unemployment rate has fallen to 3.6%. Remember, natural unemployment rate is at about 4.3%. Continued drop in long-term unemployment, as those without a job for over 27 weeks has fallen to 23.9% of overall unemployed. Again, very good, moving back towards that normal 2019 level. March non-farm payrolls slightly weaker than consensus, but still positive. 431,000 people versus the estimate of 490. Again, all of these things pointing to more reasons for rate rises. Retail sales versus inventory ratio has not budged much and remains elevated relative to history. So one of the things we do expect to see inventories remaining elevated spending and retail sales coming down, again, adjusting that a bit further. MBA refinance index has fallen considerably, now back to pre-pandemic levels. Why would you ever refinance given how rates have changed to such a point? Then when you look at government transfers continuing to fall, now makes up just 18.1% of personal income, smallest share since the pandemic started. That's going to continue, again, pulling income from people, taking that away even as things continue to slow. U.S. average hourly earnings, all employees, 5.6%, which is still strong. But again, when you adjust it for inflation, things aren't as good. And now when you start looking at new job postings on Indeed.com, starting to get some of that slowdown, as we were talking earlier with some of the leading indicators. Job plans are coming down, which means that less people are posting on Indeed because your needs are adjusting, again, showing more of that slowdown. And then U.S. labor force participation rate, prime age. U.S. labor force has recovered impressively throughout the pandemic, although not back to pre-pandemic peak. It's in line with mid-2019 numbers. Again, all things pointing to more reasons to raise rates. So that's what we have for you on the U.S. front. On the next side, we're going to talk about Europe, what's happening there, and then finally wrap up with China and Asia.